Welcome to Stat Plus, where we bring you smarter conversations on global trade, energy markets, and economic trends. India's crude oil imports from the United States surged to 218,400 barrels per day in January 2025, a sharp increase from 70,600 barrels per day in December 2024. This development aligns with the observation in our earlier video. India is strategically adjusting its import sources in response to trade deficit concerns raised by the new U.S. administration. Over the course of 2025, India's crude oil and natural gas imports from the U.S. are expected to reach $25 billion, up from $15 billion in 2024, as per recent government messaging. However, this shift is expected to come at the expense of Russian imports, as the U.S. deploys energy-related sanctions to curb Moscow's revenue streams and pressure them to end the war in Ukraine. For India, this transition carries substantial economic implications, particularly as Russian crude was available at a 15 to 20% discount to global market prices, significantly reducing our fuel bill over the past 2 years. While increased crude procurement costs are likely to push up India's fuel expenses, the direct impact on wholesale price index inflation needs to be assessed in a broader context. One silver lining is that WPI inflation has been cooling in recent months, declining from 3.43% in June 2024 to 2.31% in January 2025. A key factor providing relief is the downward trend in food inflation, which hold a 15% weight in WPI. The WPI food inflation rate has eased to 5.8% in January 2025, down from 6.9% year-on-year, driven by normalizing supply chains and improved crop yields. This could help cushion the impact of rising crude costs on overall inflation. Analyzing major market sectors by their crude price sensitivity reveals 3 distinct segments. High-impact sectors include those where crude or its derivatives serve as direct input materials. This includes oil marketing companies, refineries, petrochemicals, and synthetic textiles, which face direct margin pressure due to higher crude prices. Medium-impact sectors include industries where crude oil complements the core production process but isn't a direct input. The cement sector and airlines are examples, where crude oil and its derivatives play an enabling role in the production process or service being offered. Low-impact sectors are those where crude primarily influences transportation costs, both for raw materials and finished goods. This encompasses metals, FMCG, pharmaceuticals, and most agricultural commodities. These sectors face limited direct exposure to crude price variations. This analysis suggests that while higher U.S. crude import costs will affect different sectors disproportionately, the impact on overall WPI might be moderated by strong agricultural performance expected this year. Hence, this should not have a significant bearing on the RBI's monetary policy trajectory. At Stat Plus, we bring you smarter conversations on energy, trade, and policy decisions. Whether you're at work, school, the gym, or catching up with friends over coffee, our content helps you contribute meaningfully to discussions on the forces shaping India's economy. What's your take? Will India's increasing reliance on U.S. crude help secure long-term energy stability, or will higher costs outweigh the benefits? Share your thoughts in the comments. We'd love to hear from you. If you found this video valuable, don't forget to like, subscribe, and hit the notification bell for more insights on global economic shifts. Stay informed, stay ahead. See you in the next video.